Hi, thank you, Lisa, and welcome everyone. This is another new exciting chapter of us trying to have a broader coverage of the private company governance. And many of you probably sat through the last ones that we did more on the national level. But who better than us, right? Right here in Northern California with the talents that we have in this region to really look deeper into the private company governance, in particular with such a great partners that we have, like Louis Hott here with Foley and Lardner, that has been obviously one of the firms that is right in the heart of all the private company. I don't know how many, I forgot the number you gave me, Louis, but how many hundred of hours you sit through private company board meetings. But we're going to bring our knowledge into this discussion. And of course, Heidi Rosen, who many of you probably already know of her, has been one of the legendary venture capitalists, private company investors, sit on the board of, I think, 40 some private companies so far. And of course, we have Mikhail, who is the editor at large of Fortune, covering technology. I'm going to let them go deeper, but just to say, we're just so proud to be able to bring this cast to this webcast and have a discussion on what the current environment really call for, which is, the raise, sell, or go under dilemmas that many of the private companies are going through. So with that, I think I'm gonna hand it over to, is it Louis that want to go first, Louis?
I'm happy just to set the stage, and Claudia and Lisa, Kate, thank you so much for giving us the opportunity to come to you today. As public company board members, we often hear this mantra of nose in, fingers out. And last week, as a prelude to this new series of webcasts that we're going to be hosting on what it means to be an effective private company director, we had a dinner discussion. And one of the greatest takeaways was that, when you're on a private company board, you need to be nose in, fingers in. And that really what companies need is that private company directors become more engaged. And the number one issue with private company boards is a lack of engagement. And so we are just delighted to bring this panel together to talk about how to be engaged. And I think the most relevant topic for most boards today, which is, do I raise another round? Do I look to find out what I'm worth, or do I look to sell? And if I'm faced with being out of runway, how do I navigate? So just delighted, and Michal Levron was so kind to agree to moderate this panel so that I could sit back and participate. So Michal, I'm over to you. Thank you so much for agreeing to moderate us today.
My pleasure. I'm looking forward to learning from this conversation as well. Obviously, this is a hot topic for us at Fortune, and I'm eager to hear from all of you. And we want to take questions, so please chime in on the chat. We'll get to as many of those as possible. And chime in whenever you like. You don't need to wait until any particular time. But I want to start out actually asking our panelists for a little bit more of lay of the land. I'm sure all of you are in the thick of it and know very well all the different ups and downs that we've been through. But I'd like to just set a little bit more of the scene for this particular conversation. So what really are the biggest shifts that have occurred over the last, let's say, 12 months that are impacting all of the people on this call here to you? And Louis, maybe I'll go back to you and then kind of kick it around to the other panelists as well.
Sure, and thank you so much. And so, as everybody knows, I'm just a lawyer, and I help startups and venture firms fund new businesses, get them formed, financed, scaled for growth, and then hopefully some sort of an exit. And since the beginning of 2022, it will not be lost for anyone on this call that we saw a very significant correction in the public markets. It began with an interest rate positioning shift from flat to down to up. And that's really continued through all of 22 and into 23. And in fact, here we are today on September 19th, 2023, and we're expecting more interest rate increases. And so that really takes investors from a risk on to a risk off position. They're able to find returns through debt instruments and more safe instruments, and they go risk off. And so while I think the FANG stocks and the big public company stocks have recovered wildly in 2023, that has not translated into the smaller, newer public companies. And so we haven't had an IPO market until maybe last week. And many of us expected that 2023 would be the year of a lot of M&A, as many companies kind of would accept the reality that they weren't able to raise another round, or not at the same valuation, or that an IPO wasn't going to be possible, and that they would capitulate and sell. And we have not yet seen that. We've seen founders able to raise, with flat rounds or with convertible notes or safes or some other instrument that kind of shields them from the dreaded down round. So that's the environment, Michal, that we find ourselves in, is founders and companies getting towards the latter stages of their runway, and the requirement to raise again in order to grow or to get to some sort of an exit. Second, many companies either are primed for an exit because they've really reached that critical stage, or they're out of runway. And then lastly, there are many companies that are navigating really the end of that road, and what do they do next? And I just couldn't be more delighted to have Claudia, Heidi, and obviously all of you in the audience to participate in this discussion.
Heidi, Claudia, do you have anything to add just on the scene setting from the investor perspective?
Sure, if I can pile on. Yeah, my day job is I'm a partner at Threshold Ventures. We focus on Series A. 375 million is the current fund, so we're in there at the early stages. I would say two things to pile on to what Louise already said. Number one is there is a resetting of value, right? So that because of the market, because of where the interest rates are and the other opportunities for investment, and just everything trickles down from public markets in terms of pricing private companies, although there's always a lag in that. So there is a repricing, there is a downward trend on valuation. That said, there's plenty of capital in the market. This is not a case of capital disappearing. There is capital. A lot of venture funds have their coffers full. And so there is money available to companies, but there is a valuation reset. And on top of that, I think there is a priority reset in terms of sectors. There is a tremendous amount of attention on AI right now. I joke that, back in 1999, you just put .com on the end of your name, and now you put .ai on the end of your name. But there is a tremendous excitement around AI, and every day you read about AI companies raising 100 million or something like that. And so I think that's just another dynamic overlaying for the early stage entrepreneur. How do you navigate this? It's another complexity to the navigation.
Yeah, just, these are all really great points. I think one other point we'd like to have come through this discussion is also, to not just think about, the raise, sell, or go under as a current state, but how do you prepare your company as a private company board member long before you get to this stage where you have to make this kind of hard decision? What our type of advice? Louis said, wow, nosing fingers in, but how do you really, even when they're not in the position of raising or exiting, what are the important factors that you as a board member can help guide your company into potentially making the right decision when you get to that stage?
Claudia, we didn't get a chance to talk about this because you've spent the last 5 years at NEA, but it would be helpful if you reminded the audience of where you spent the prior decade before that at IBM, and you gave us some great statistics in the lead up to this call about the number of acquisitions that IBM did in that period, and specifically the number of those acquisitions where you had perhaps already a commercial engagement.
Well, thank you, Louis. I mean, as actually Michal and Heidi both know that I spent almost 15 years running the IBM Venture Group. And, one of the things that we were very active is acquiring private companies, a venture-backed company. We have a very strategic way to look at where we fill the gap and where we address the new, market and new technology and business model, which is something we're going to talk about a little bit more. But the key points that I raised when this group had a discussion is, we look at the acquisition. Most of the M&A activity are with companies that were already in some level of a strategic partnership with the acquirer. This is not, go shop. It's sort of open shopping. And that, in our 74 acquisitions that we've done, only one of them was not already a commercial partner. And the only reason for that is the ones that we wanted to acquire got snapped out by our competitors. So we have to go with, a replacement candidate for that. So that is just to emphasize the point that I was trying to make. How do you position yourself in that pipeline for, hopefully IPO market is opening, Louis, but, absence of IPO market, your M&A is really a very, very, very viable exit for all the companies.
So I think I heard pro tip number one from Claudia as a private company director. If you want to have an M&A pipeline, have commercial deals with each of your potential acquirers. I'm gonna write that one down. Thank you, Claudia.
Thank you, Louis.
Thank you, Claudia. And I know we've got a question already on the IPO market and Instacart, and we will absolutely talk IPOs a little bit later on. But I want to get back, we're talking about raise, sell, fold, right? And we'll hit all of those. But back to fundraising to start with. Heidi, you mentioned that there are AI deals that are happening. Hopefully some other deals as well, of course. But when it comes to fundraising in this climate, talk a little bit about, what are the possibilities realistically, and curious to hear also, what do independent and non-independent directors need to know about structural versus non-structural raises? And Heidi, we'll start with you and then go to the others.
I'm glad you brought up structure, because I think that is the number one thing. I mean, obviously, the number one thing is if you're on a board of a company and they're going out and all they're getting is no's, you have a problem. But we're going to talk about that later. The other thing you're going to have is the proposal of down rounds. There's nothing wrong with a down round. It's a repricing. It's a valuation level setting, in my opinion. It's painful because as a VC said to me when I first became a VC, valuation is the grade at the top of the paper. It's the thing people talk about at cocktail parties. It's the headline on all the news feeds we read. But the issue is valuation actually is not the most impactful element of how value will ultimately be given to all the shareholders. It's terms and structure. And so the problem that always happens is you get a term sheet, it's a down round or something, it's flat, and the entrepreneur and the board says, oh, I hate this, they're going to cause us so much trouble. And you go back to the new investor and you say, I really want this to be an up round because my ego and emotions and all of that. And so how about we put in some structure? How about we give you a senior participating preferred? We'll give you a multiple on it. There's all sorts of bells and whistles that have been invented because they've worked in the past for raising that valuation. But fundamentally, what I would say to all of you, because of course in public companies, this really doesn't come into play, super comes into play in private companies, is if you think about it this way, structure is a way of giving downside protection to new investors. Fundamentally, that's what it's about. And when you give downside protection to some class of shareholders, you are taking it away from some other class of shareholders. And so simply put, I think for any term sheet, if you are going to have structure, you should have the company do an analysis of what that structure means to payouts across your classes, including common, at various outcome levels. And my spoiler alert to you on this is what you will find is common will do way worse in low to moderate outcomes, and they'll do a little bit better in really great outcomes. And all entrepreneurs think they're going to deliver great outcomes, but the reality is most deals settle in the low to moderate outcomes. So I would just encourage you to be sure you do the math. There's nothing illegal, wrong, bad about any of this structure, but I think often you will find that structure is not to the benefit of the common. And let me make one more comment about this before I leave this topic, because it's super important. In public companies, we're all used to all the directors being the same. We're all independent. We all represent the shareholders. In private companies, you do not have that situation, right? You have different board members who represent classes of stock. As soon as you put structure on, you are creating vast discrepancies in what the outcome will do for each of your classes of shareholders, right? If everything in the world, if you could always have pari passu and everybody have the same terms, then everybody can sort of look at deals the same way. But let's say, for example, to use an extreme case, and I saw these in the dot-com bust, the last money in had a 5x multiple. No kidding. They look at every acquisition offer after that and they say, I'm going to make 5 times my money back, even if everybody below me on the cap table gets screwed. And so the incentives you create when you put structure into deals become very disruptive down the line to private companies. And so as independent board members, I think it's really important to understand that. That's not happening to you as an independent, but it's going to influence everybody else around the table.
So if I could just scintillate another pro tip, which I think I just heard from Heidi. I think everybody knows how to pull down a cap table from Carta. I'm not sure that all directors have access to that, but that's easy to access or to obtain. But maybe you should have a pro forma cap table, and maybe you should have a waterfall analysis, which demonstrates all you have to do is plug in a number and what everybody gets if there's an all cash deal for X, Y, or Z, which would demonstrate the impact of structure.
It's really hard to understand this from a cap table. You have to do a waterfall analysis to actually understand it.
Exactly. Great pro tip. Thank you, Heidi.
Yeah, no, it's such an important point. We got a lot of questions when we did nationally from independent board member of private companies saying, but we got all these investors on the board. Do we really have to participate, on the fundraising discussion? And you just heard the answer to that. It's absolutely yes.
I want to get to, we've got a couple of questions here. So before we move on, let's get to them. And one of them, great question, just timing, what age stage of a company, great question for everybody, right? How to raise funds and how to select whose investment to take, which I think was probably a better question a couple of years ago, maybe when there were so many options there. But Heidi, Claudia, any thoughts on this, just timing wise? Obviously it's tough timing all around right now, but anything more in depth you have to share?
Well, Heidi and I both teach that at Stanford Business School to a group of entrepreneurial students, which is the profile of Stanford Business School. And my advice to the student has always been, don't raise when you need it, right? Raise when the money is available out there. Of course, watching all the terms and the dilution, all that. I do think, the C stage round are going very strong right now. And I think if you're starting a company without the down valuation, all that challenge, the investment, the money is out there. So if you're starting a company and you think this is, because of interest rates, economic downturn, you'll be making a mistake, because this is actually a very healthy environment for early stage. I think like 2 out of 3 deals right now are early stage C deals. So they're going very strong right now. Choosing your investor, that is a whole, a whole new different discussion. My advice is, if you have the choice, and I think, you insinuate, Mikhail, that you don't always do, but just realize you're going to be married to these people for a long, long time. You're tying your future. This is sometimes, harder than marriage to balance the relationship between the founder, CEO, and the people you take money who will sit on your board, help you grow the company. So do look for a little bit more the personal. Don't just valuation shop like many entrepreneurs just want to see who give the higher valuation. Really pay attention to the personal aspect. These are people you literally have to live your life and tie your future with too.
I'm laughing at what Claudia just said, because the average duration of a relationship between a Series A investor and from the point of investment to the point of liquidity is 7 years, which is about the average duration of the American marriage. So it really is true that
The 7-year itch, right?
7-year itch. Yeah. So, and then I will just make my Captain Obvious comment. What's the number one reason private companies go out of business? Because they run out of money. It's like, it is so obvious. That is the day you will close, is when you can no longer make payroll. And so the fallacy entrepreneurs have is that you try to raise money, and if it doesn't work, well, you can always sell the company. Well, you can't always sell the company. I tried to do an analysis of my own. I've been doing this for 25 years. And I would say when you get into a situation where you have less than a year of runway, and most entrepreneurs will wait till about 6 months, which is way too late. But if you wait and you have less than a year of runway and you go out to sell, I would say in my own experience, about half of those companies will not sell at all. They just won't find a buyer. And of the half that do, about 80% of them will not clear the preference stack. So the chance that you're going to run your company down to 6 months of cash and then find a buyer and make everyone whole is extremely, extremely small, which is why I would underscore what Claudia said, is raise money when you can. And particularly if you're a company that is not, especially if you're a deep tech company or something like that, always be thinking years ahead, always be thinking of sources of capital other than pure venture. I'm a huge fan of corporate venture and strategic investors. There are other ways to fund companies, but never let the gas tank get that low.
There's a question in the chat as well on sort of the notion of, I think, VCs sitting on cash. Any thoughts on, deploying new cash to new companies? You talked already about some of the activity that we're seeing in seed stage, some of the activity on, AI companies in particular, but is that notion accurate to begin with? And I know some VCs are struggling to raise their new funds at the moment. So there's that element as well.
I'm sure that Claudia and Heidi are not in this situation. So let me take this one. But I do see a lot of funds who traditionally were looking at the forward environment, thinking they were going to raise their next fund in 3 years. So if they had 100 million in their fund, they would be looking to deploy 33 each year. And then of that 33, they would look to invest, X in new companies and then reserve Y for follow-ons in subsequent investments. And when you looked at the decline in public company valuations beginning in 22, fund managers other than the wildly successful ones, Claudia and Heidi, started to think, well, hey, this is not going to be 3 years. Maybe it's going to be 5 years. Maybe it's going to be 7. I need to slow down and invest less per year. And really, maybe I need to start with buttressing the companies that I like in my portfolio that I think could be winners if they just had enough capital. And so I think that's the basis of the question. And I think that we are nicely starting to see a new IPO market. We saw a great exit that SoftBank had with ARM last week. And it was also a great exit for the Vision Fund, and which is now flush with cash to invest in new AI companies. And we're seeing Instacart hopefully to have a nice launch, and then Klaviyo right after that. So we're starting to see some exits there, and we're starting to see some capitulation of these companies that won't otherwise have an exit. And so I'm starting to see venture investors who were kind of tight-fisted starting to open up again. Sorry, Claudia and Heidi, I thought I would just take that one so you didn't have to.
No, that's exactly right.
And I would say, you can only sit on your cash for so long before the LPs wonder if you're actually working. So on the one hand, there is kind of motivation to invest the money. On the other hand, you don't want to just invest because you need to have a certain deal pacing. I mean, at our firm, we did slow down in the beginning of this year because we wanted to reassess the market and what the right valuations are, what the pricing is. We're seeing that pick up right now. I don't know if that's just anecdotal to us or just it's September and everybody wants to do some more deals before the end of the year. So
and the economy wasn't nearly as bad as everybody anticipated it will be, right? So I think that is definitely, but just like what Louis said, there's just so much of a reserve mentality, you know, by the time we hit 2022, that's going to take longer. The top, you know, portfolio company is going to require more funding to reach that success point. So all that is true, but you know, if you look at the first half of this year, we are seeing a pickup. You know, it's definitely, like I said, the early stage companies picking up, you know, more than the mid and late stage companies. So that is a healthy sign of new investments.
Well, this is definitely a glass half full set of panelists here. I'm happy for that. So let's keep the conversation going and turn a little bit to selling. You all touched on this already, but tell us what we need to know about the current climate. And Louis, maybe we'll start with you. You know, I'm curious also about the regulatory side. Is that having an impact, and what else are you seeing?
Sure. Just quickly, since the beginning of the Biden administration, we've seen a Federal Trade Commission, which was really mandated to make a difference in what was viewed as an overly aggressive technology industry. And we saw really a tightening of the application of antitrust laws, and subpoenas went out to the large tech companies that were the most prolific buyers in tech. We're talking Microsoft, Apple, Google. They all got subpoenas, and they got subpoenaed on the small acqui-hire deals that are below the reporting threshold, which really shocked people. And you know, I just got to tell you anecdotally, I don't see them in the market at all. I'm sure they're doing things, but I don't believe they're in the market. And so that's taken out a lot of pressure in the system. And as a result, I think it's one of the big drivers of why we see less M&A. So who's left? You've got large unicorns, but they don't want to be spending cash. They're willing to give you stock maybe, but they will not generally buy with cash. And that's not the preferred outcome for a venture capital investor. And so it's been challenging. No IPO market, no big tech buyers. So you have private equity portfolio companies that'll do add-on tuck-in acquisitions for cash. So the environment has been tough, and I'll just stop there and say that's the stage that we found ourselves on, and hopefully now we're starting to lift up again. Heidi, Claudia?
No, that is correct. But the point is, you know, you saw it's the time value of money, right? I mean, if you have a relationship with an acquirer, you do reach a certain scale where the company will look at you as part of the organic growth strategy, and then you can weather a lot of, you know, what Louis talked about, obviously, all the regulatory demand. By the way, that was a nasty thing that the company had to respond to. But our message is, you know, if you want to sell your company, the company are not sold, they're bought, right? So you can't just push yourself onto the marketplace and things you're ready for.
Louis is writing this down, I can see.
Pro tip number 5.
Yeah. Well, and I think that's another, I mean, the classic thing an entrepreneur might do. Hi, we're going to be out of money in about 9 months. So do you know any boutique bankers? And here's my deck that I was unsuccessful raising my last round with. Could you please circulate this to, you know, Microsoft and Google and Meta and see if any of them want to buy us? I mean, we're all kind of laughing, but it's amazing how much that happens. One of the things that I try to tell entrepreneurs is, look, just like strategic investors, they don't invest in startups to make your stock go up. They invest in startups to make their stock go up.
Yeah,
that's why they're called strategic investors. And the same thing is true of a buyer. A buyer is generally not going to buy a rinky-dink little startup because you're going to add a few $1 million to their revenue rate. They're going to buy you because of the leverage you bring to their company, the turbocharging you can do to some particular market or sector or new development area or something like that. And that's the only time you're going to get the kind of returns that you want to get. If you're really just going for the, as I call it, an exit with honor, right? We can't keep the company going. Let's find a home for the employees and the customers and all of that. those are usually going to be very small. You're usually going to have to put carve-out agreements in place because they're not going to clear preferences, and you kind of can't sell these companies without the employees going along. And then burn rate's really important, which is also kind of hard for entrepreneurs to understand. If a company is buying you, they have to put you into, whoever that product manager is going to put you into their budget. And if you're burning $10 million a year, that's $10 million a year they have to support. And so if you are in the situation of you need to sell a company and you didn't already make those strategic considerations, getting your burn as close to break even as possible, first of all, extends your runway so that you have time to find, hopefully, a buyer. And second of all, is much more attractive to the buyer because you are, you're more attractive because you're not burning capital that they're going to have to supply once they buy you.
Right. Such a great point, but emphasizing on the point that Heidi mentioned, you have to really think about what do you add to the buyer, and not that you're making $20 million revenue a year. When I was with the IBM Venture, we were $100 billion a year company, and to be honest, we passed $25 million customer deals just as a threshold. So to think that you can add a little bit to it, well, you have to add that little bit and drag about $200 million of our other stuff along with you. So always approach the strategic buyer when you're thinking about partnership or potential outcome of M&A, in terms of how much do you add in the revenue uplift for them, not just for you. Obviously, their scale, their distribution power is going to add tremendously to your revenue potential, but what do you add to them at the scale that they are at?
I want to just double click on that for a second, because I think it's might be a little bit subtle for our members of our audience. But if you think about a startup, they often look at their valuation as just a multiple of their last 12 months revenue, or they're assuming there's sufficient growth and it's break even. But to Claudia's point, a large tech buyer maybe is not going to be that excited. It doesn't move the needle for them if they get 10. But if they can walk you into their sales force, just plug you in, and their sales force could then multiply those revenues by 10, that's really why a big buyer would be looking at you, and why it's so important to have some kind of a commercial deal already with the buyer, so they know that at least their own internal clients actually are using the product or are partnering with you and putting it through the channel. And so I just thought I would give that example.
And Andrew, we're going to get to your question in just a second, but Heidi, I'm wondering if you can shed a little bit more light, just any other tips when it comes to those strategic relationships, sparking those partnerships early on that people should know.
Yeah. I mean, the hard thing to understand is the right day to start that was, it's like the planting a tree thing. The right day to start was when you first started the company. The next best time is right now. And so it is something that is, I mean, if you think about it too, entrepreneurs, they want to have an impact with what they've created. And strategic partners can really leverage your ability to impact your customers, the problems that you're trying to solve. And so I think it is a different way of thinking. And that is, since most entrepreneurs do want to continue to have their companies be independent as long as possible, it is a really different way of thinking, but it is actually the outcome that most companies that are successful will have. I mean, the day you take investment dollars, you are sort of creating a situation where you will have to sell that equity eventually. So I actually have a book to recommend. It's called The Magic Box Paradigm, and it's free on Amazon right now if you do the Kindle version. I told everyone ahead of time I hesitated doing this because it is written by a relative of mine. So he has the same last name as me, Ezra Roizen. He's my nephew. But he's also really good at this. He's been a boutique investment banker for like 20 years in the tech industry. And he's written a book that's sort of a roadmap for an entrepreneur to understand how to develop biz dev relationships that could lead to corp dev. So you might check it out.
Heidi, you should also tell everybody about your podcast, because I think
Yes.
that's a
Yes.
great resource.
Yes, not, this is the commercial section of today's TV session.
They're
but
all free, so.
I do have a podcast called The Startup Solution. It's available on all your regular podcast apps. And every week I take 15 minutes or less and I unpack a challenge that an entrepreneur faces using real experiences from my past, and then explain how to get through it and hopefully solve it, or if not solve it, at least learn for the next time. So
Thank you.
But adding to that, Cal, I mean, I think if you're devising an early stage company, you're dealing with a visionary, you're dealing with a CEO or founder that obviously are forming a company because he or she has a great vision of something that is disruptive, that is going to serve a large marketplace. But that also too often mean they put their blinders on because they have such a, conviction of what they need to do and what they want to do. And your job as a board member, particularly as an independent board member, is really not unlike in the public company board, is to bring these other perspectives, right? To help him or her make decisions outside whatever the comfort zone or whatever the current state of their strategy, and being aware of what we just talked about, of these potential strategic partnerships that are out there. They can be your first customer. They can be somebody you want to be a pilot customer, joint development partner before you even sell anything to them. I mean, I used to tell CEO, you can sell to us, you can sell through us, you can sell with us. There's so many ways that you can establish that partnership. And you as a board member really should ask those questions. Are we reinventing wheel? Are there other, partnerships that we can be looking at that can really help us, one, reserve capital, right? Which is a very important point in this discussion, that we don't have to invent all the resources ourselves. And two, that will prepare us for those type of larger strategic relationship we want to seek.
Please keep the questions coming, by the way, in the chat. Just real quick before we move on to folding, a fun topic for everyone. Question here on the current environment. I'm guessing fundraising environment for very, very early stage, pre-seed stage, even companies. I'm guessing you guys probably think those companies are probably best positioned right now, as long as they stay lean and are able to keep it going. But any advice for what the environment looks like for friends and family stage?
It's so dependent on the company and the sector and what they're doing, right? And so there is a very active market. There are a lot of Series A investors like me out there, and that's our hunting ground. And so I would say there is a lot of appetite for that. I think also there's a little less price sensitivity because, again, you've got 7 years to sort of make the market for that company. On the flip side, it is very hard to sell a seed stage company that's got a couple million in it and doesn't have an MVP. And you used to be able to do acqui-hires, but the job market is really soft right now. So the acqui-hire opportunity is not really there for a lot of those companies. I guess there's our segue into shutting down. I didn't mean to do
Okay.
But just keep in mind of all the different sources of capitals that are available, right? It is not just VC. I mean, we talk about CVC, and there are corporations that doesn't have a corporate venture arm, but still make strategic, minority investment. And there's incubators and accelerators that has an equity, investment arm to it. So make sure you sort of know all the different sources of capitals that are available to you as an early seed stage company.
Great point.
That's one more really important point. We live in the epicenter. Here we are in Silicon Valley, where the first thing you do is go to Sand Hill, raise $1 million and print the t-shirt. But the reality is, for most of the world in entrepreneurship, there is no such thing as selling equity. They make money by solving a customer need and having the customer pay for it. And what's super awesome about that is it's non-dilutive capital, right?
Yeah.
And so one of the thought exercises I think is really important for startups is, imagine you could never raise risk capital again. What would you do to keep your company alive? Now, for some companies, the answer is I can't, because there's a long development cycle or something like that. But for a lot of companies, especially those that are software companies, you can actually get down to a place where you can make a living, or at least break even, off of your customer base and live to fight another day, which I think could be, for some companies, very important and a survival strategy for today.
I think the number one fundraising tool of 2023 has been multi-year customer deals. So instead of selling a product, one widget, sell a subscription to it, sell it for 3 years, take all the cash up front.
Or take a product, white label it to a big company. Take a product, sell a certain sector to another company to pursue. Sell another geography to another company to pursue. They're all ways to generate non-dilutive capital.
I think you're talking about the magic box again, Heidi.
Sorry about that.
All right, folding.
Okay, folding. So, Louis, I'm gonna go to you first, and there are so many different questions here within folding, and why is it so hard to talk about, and how do you start talking about it? But I want to first get from you a little bit of just the legal aspect. What are the legal considerations as companies look at this option?
And all directors need to know that they have fiduciary duties, and their number one fiduciary duty is a duty of care, which is to attend meetings, read the materials, have regular check-ins with the founder, CEO, whoever it is, and have a duty of loyalty, which is, obviously, if you're a director being designated by a fund, you're wearing two hats. You've got your fiduciary duty to your funds, but also to the company as an individual director. At some point, you also can have a duty to creditors, and that can happen when you're operating in what's called the zone of insolvency. And
that doesn't sound good.
Some startups feel like they're always in the zone of insolvency, and so rather than decide if you are or you aren't, a pro tip is to always have a sheet of payables so that you know kind of how deep you're in. And what does that mean? It means I know what I owe in 30 days, 90 days, and over the next year. And that's really kind of the zone that I'm talking about. And when I look at my payables, I'm not only looking about, how much do I owe the landlord, how much do I owe my service providers, how much do I owe Amazon Web Services or whatever, but also my employees. And when I look at payroll, I need to be thinking about how much PTO I owe them if I'm in fact paying PTO. How much do I owe my insurance carriers? And gosh, I should have led with this, payroll tax first. And any kind of taxes are kind of, in the priority of payments, it's employees and then taxes and then everybody else. So to have that on a spreadsheet and know kind of really what is your comfortable runway, what is your stretch runway if you're to furlough people or to kind of let go of people and then hunker down into just a small team that could just sell the assets, who is it, who would you need, and how much would it cost, and really have kind of a scenario plan for that is what I would recommend. So that's kind of the legal landscape as directors that you've got to be thoughtful about, is what is the zone of insolvency. And there should be a slide in every board deck saying where are you from a cash position month by month for the next 12 months, and when are you cash out. And venture investors like to see companies that have runway for 18 to 24 months. For most companies out there, that's a luxury. And really the cash out date could be, month to month, and they're surviving by some sort of a revenue coming in, whether it's an NRE or a sale of a subscription. Sorry, Heidi, over to you.
I just was going to say, and when you say cash, you would think I wouldn't have to say this, but debt doesn't count. I had a number of entrepreneurs recently tell me, well, I have $3 million left. And I say, well, where'd you get that? And they say, well, it used to be SVB, but we know how that, anyway, they would say, well, I have some debt. It's unsecured debt. And unfortunately for what Louis is talking about, you don't get to debt does not float you out of a zone of insolvency. It's debt. Doesn't
Yeah.
matter. But a lot of entrepreneurs don't realize that.
Heidi,
Let
Claudia,
me just circle back to another point. Some entrepreneurs think they can actually borrow money at that time. And Claudia said something prolific, which is that you should only be fundraising when you don't need the money, because no one will give you the money when you need it the most, most of the time. And that is particularly true for lenders. And so I always advise entrepreneurs right when they close an equity round to, in fact, lock in some sort of a debt facility. You usually pay a small fee to lock the facility in. You don't draw it. It's just available for a rainy day. Now, to Heidi's point, if it is a rainy day and it's raining really hard, the lender is not likely to fund it if you wait too long. So you would want to draw it down when things aren't so terrible. And of course, you would have to have the idea and the hope and some prayer that you would be able to pay it back to your duty to creditors. Back to you, Michal.
Yeah. I'm just curious, Heidi and Claudia, if you have other thoughts on timing, when to start the conversation, and then let's get into how do you have the conversation, which is so hard.
Well, it is something you always, just like, both Heidi and Louis said, you always have to have that in plan. I mean, I would say hire a good, legal advisor, somebody who will look at your, your cap table and advise you on that kind of thing. We get a lot of call as a acquirer on companies that think they need to sell, they need to, otherwise they will fall. And I can tell you, those are the worst call. I mean, we literally assign a very low level, teammate to just field the call to be polite. It is not a successful outcome in general. And when the transaction does occur, it really is much more of a fire sale than it is a real M&A deal. So I will say have those things in plan, just in case you find yourself in that decision point. It's not something that you're just struggling at last minute and go out as a panic, mode. I think your general counsel, unfortunately, many of the younger companies don't feel they need to invest in that, which I actually think is a mistake. These people have seen so many different shape and form of how company seek out, acquire, partner, and other. Always a good idea as a board member to make sure that kind of outside resource and advice are being utilized for all the life cycle of the company.
I think that's a super important point, because for some inside VC baseball, I'm assuming most of you are not VCs and you're an independent board member on a venture-backed company board. The entrepreneur really almost always wants to push it as far as they can because it's their life's work, it's their mission, they don't want to give it up. The VCs have indemnifications with their funds. If the company goes out of business and gets sued and all that, it's not going to come out of the VC's pocket. It's going to come out of the protection their fund affords. You as an independent, you don't have that. And even if you have signed an indemnification agreement with the company, as my lawyer likes to say, you can't draw blood from a stone, right? If there's no money left, they're not going to be able to protect you. And so I think it is very incumbent upon the independent directors to know where the zone of insolvency is, to not go there. And I think it is also incumbent on VCs. The beauty of venture money is it is not debt. It has a debt-like structure in the preferences, but it is not debt. And we're in the risk business. So our deals fail. It's one of the frustrations I have with the venture industry is why VCs have to make entrepreneurs feel bad about companies failing, because we're in the risk business. They're highly risky companies. They don't always work. Most of the time, the entrepreneur is trying to do all the right things. There are good reasons why companies fail. And so having an honest discussion about, I call it pushing the red button, which is the day you say, we either have to find a buyer or shut down. And shutdown date is you work backwards from the day that you would be insolvent. and you figure out how much time does it take to do an assignment to the benefit of creditors, or to do a wind down. If you're never insolvent, you don't have to do an assignment to the benefit of creditors because you take care of your creditors. And so that is just, to me, that's where you draw the line. You say, how much, I need 60 days to wind it down appropriately, give people their, their notice, that sort of thing. You know what that date is. And maybe 6 months before that date, you say, this is the date where we really have to cut the burn, try to find a buyer, saying that, if you didn't do all that other stuff and you don't have a better buyer, that's where you have to go. But I do believe you, as an independent director, you will probably be the person who has to have those rational conversations. And on behalf of VCs, I am sorry that it falls to you to sometimes have that conversation, but that's what I've seen in practice.
Do you have any tips, Heidi, for how to approach, given all these dynamics that you're describing? I mean, including the stigma around it, including what the founder is, where the founder's typically at, and the fact that they want to keep going till the bitter end. How do you approach?
I think a lot of this is the day you take that board seat, or when you're interviewing for that board seat, to be able to have conversations about, here's how I see my role as a governance person. I'm going to watch out that we don't end up crashing and burning. Sometimes crashing and burning means, sometimes not crashing and burning means that it may not work. Here are the stats, right? You can all go look up the stats on this. I think having that conversation with the VCs, I think asking the right questions. It is amazing to me how often, if you ask the question, when would we hit the zone of insolvency, that it can't be answered because nobody did the math before you ask that question. And again, that they throw in things like debt, thinking that debt is actually cushion and not just another component of what you owe. So I just think asking those right questions. And I think that instead of waiting for the dumpster fire to be happening, saying 6, 9, 12 months up front, if we don't have clear, if we haven't raised a fund, a new round by X date, we need to start thinking about cutting and winding down or finding a sale. Say that up front, get the date, get everyone to agree, because when it is that date, nobody wants to agree then, because also by then you've already sort of laid the groundwork for the dumpster fire. And so you can't avoid it. It's much easier to say, let's avoid it by having this be our line in the sand.
I do want to, I know we're a little bit tight on time here, and I want to make sure that we get the some of the initial questions around IPOs and the market and what we're seeing. And is there cause for excitement, or should we be a little bit more tempered here? Louis, it sounded like you were optimistic, but can you shed a little bit more light?
Well, I don't want to get too optimistic because, as we know, IPOs have to price well, they have to have a first day bounce, and then they have to continue to trade up. And really, you're looking for a 20 to 25% bounce on day one so that the initial purchasers in the IPO lock in some kind of a return. And then you're looking for the buyers to come in and continue to build positions and hold over a 1 year period. And so we haven't had an IPO market since the beginning of 2022. The fact that ARM and Instacart and Klaviyo are going to price well and hopefully perform well initially, and that's again not a given yet, it is cause for optimism. But we're going to really need to see those continue to perform over the medium term period before we can say that the window is open. I am continuing to hear from investment bankers that they've got a great pipeline of companies that they're going to be bringing out, late stage companies that are having this magical rule of 40, which is revenues that are of a critical mass, and to go public, that's probably around 100 million. If you're tech and life sciences, it's a totally different ball of wax, which we shouldn't confuse. You need to have growth of probably 40%, but at least 20%, and it's got to have some sort of a sizzle. So those are the key ingredients of a healthy IPO, and we're hoping to see the beginning of the cracking of the window open right now, and that's what I could tell you, Michal. I don't know if Heidi or Claudia have other observations there.
You're not throwing a party quite yet, Heidi, Claudia? No. Okay. So again, I know there were some questions we haven't had a chance to get to, but I do want to make sure to just kind of summarize real quick. And Louis, if you don't mind, you are so good at just getting those takeaways so succinctly. Any quick thoughts on just what your takeaways are from the conversation?
Thank you. I
Put you on the
think
spot.
at the outset of this presentation, and the really what we're trying to bring in this whole series, and there are more webcasts to come, as Lisa has told us in the chat. Being a private company director is just very different from being a public company director, and the effectiveness of each director and the board and the company as a whole is really going to be a function of your engagement, your ability to bring value, and sometimes that means you're going through your Rolodex and your LinkedIn trying to make customer introductions. Sometimes it's helping your private company make a key hire, so it's introducing them to salespeople or engineers. Obviously, investors, because you're always raising, or helping the portfolio company or the private company get introduced to somebody who could be their future acquirer. I have a great CEO client, and if he or she is listening, he or she will remember themselves in what the statement. He or she told me that every time they meet someone, they're looking at them immediately. Is this person a potential investor? Are they a potential acquirer? Are they a potential employee? Are they a potential business partner of any kind? That's what you as directors, really what your CEOs are doing. And so if that's what they're doing, what do they need you to be doing? And that's what this series is really all about. And so we'll put together a blog post of the pro tips that we got from Heidi and Claudia, who are so generous. Thank you so much for gracing us today with all of your thoughts. And I think I'm excited about the webcast to come.